Just to introduce myself, I think I've said a quick hello to everyone, but my name's Julie Holliday, and I'm the financial controller of the Saturno Hotel Group, which operates 8 hotels across Adelaide. Bit of background, I've been an accountant for about 20 or so years. My background, I've been with the Saturnos for about 4.5. I was also at the casino in the financial controller role for just under 10 years. So got some experience in big business and small business. The thing about accounting is you can work in any industry in the world, the principles are the same. So I've also done a little bit in health, in waste management, in mining and public practice. So done a few different things. As Fleur said, today's session is a little bit of it's going to be fluid because finance is a really big topic, and certainly you guys didn't get into hospitality and look for a career in hospitality because you love numbers. I get that, but in a role as manager, it's really important that you have an appreciation of what the financial reports are aimed at doing and how you can use them in your roles to improve your business, but also just present really well to your supervisors and the owners of your business as well. Having an understanding of finance is essential for any manager. It's also transferable, so if somewhere down the line you decide to get into something else, finance is still going to be important as manager. So I want to work with you today to make sure we cover off the things that are really going to help you in your roles, and we'll brush over some of the technical stuff. You have to have an understanding of it, I guess, or an awareness of it, but really that's not where finance is going to help you in your jobs. So the 2 units that we're covering off today in terms of your certificate for are interpreting financial information and managing finances within the budget. That's a lot. So the other reason for keeping the session fluid is I don't want to overwhelm you with debits and credits and numbers and assets and liabilities. So we're going to try and keep it really targeted, and I'm always available. If after the session you've got a question, please make contact with me and we'll work through it. Now, interestingly, in the questionnaire that you were given before you started your certificate for, many of you listed finance as one of your most important subjects that you wanted to develop your skills in. So with that in mind, I'm hoping that you might be able to give me some ideas of the particular things you want to cover off today, and then we'll whiteboard them and make sure that we do cover them off. If there's anything in particular from the assessment. And that's okay too. We'll just work through the presentation as we've got it, and we'll see where we end up. Okay. Now, I hope you've had an opportunity to read the course materials that we provided. That gives you a context of accounting for managers, for hospitality managers. And from that information, you'll appreciate that there's 3 key reports that any business will use to assess their performance. And by performance, we mean the health of the business, which can be their profitability, their stability, and the likelihood they're going to be around for the long term. So, as I said, the purposes of these 3 reports, which is the cash flow statement, the balance sheet, and the performance report, is to identify strengths and weaknesses, to measure value, and to identify where you should focus your effort for the best return. When we talk about return, we talk about money in the bank, profit. Now, we're going to focus on the performance statement today and also talk a little bit about management reports, which sort of, it doesn't fit into any of those particular categories. The balance sheet and the cash flow statement are, they're reports that are probably more valuable to the owners of the business, to banks or others that might have lent money or have an ownership interest in the business. For us in our day-to-day roles, managing our staff, selling product to our customers, servicing our gaming room, the balance sheet and the cash flow really aren't relevant. So we're going to focus on the performance statement because an understanding of that is where you can make a difference to your business. Okay, so how to read your performance statement. Now, everyone's got their activity sheets, their assessment guide, and if you've got it there, it'd be good if you could turn to activity 5, because we're going to use that performance statement for our discussion. Now this performance statement that we've presented in your assessment guide, it's a format that I'm familiar with and that I use in my role here at Saturno's. Your business the format of your performance statement for your hotels may not look like that, and that's okay. Like, people will design reports for their use, and they're all going to tell you the same story and report the same numbers, but they might be presented a bit differently. So don't be concerned if this doesn't look quite like the information you may have access to. I'm sure you'll still be able to relate it back, and if not, I can help you with that. Okay. So in most businesses, the performance statement is prepared on a monthly basis. Really, all it is, it's a summary of the performance of the past month. You'll have all of your revenue streams identified on that report, usually grouped together with the costs that are associated with earning that money. So you'll have your bar and your dining revenue, you'll have your gaming revenue, you'll have cost of sales, which is the cost of serving a meal or the cost of serving that drink, actual product cost. You'll have payroll, which is your staff cost, and you'll have other expenses. You might have an oven that was repaired for the month. You might pay rent. You'll have electricity. You'll have gas. So the performance statement is just capturing all of that information and then giving you a result. A bottom line result that is essentially how much money you made for the month. It's not quite what you put in the bank, but that's perhaps an analogy that you'll be familiar with. Now, on its own, a month's financial information isn't really helpful. And so to make my point there, if you cover the activity 5, cover the 2 columns budget and previous, and then we're just looking at the actual column. Now, the actual result for the month was $20,689. Is that a good result? You don't know, no. So you actually have to compare it to something. I mean, you'd go, yeah, it's a good result because we made profit. Yep, so that's a big tick. Did you do as well as you could have, should have, would have liked to? Looking at that column in isolation, you don't get that. That's why if we will also compare the result for the month to something, to a target. Now that target might be your budget. It might be the same month last year. It might be a comparison against, for us, we're in a position where we can compare it to other hotels in the group. So you can get an understanding of how the business is operating by comparing it to something. On its own, the numbers aren't particularly useful. Now, the other thing to note on this particular report and most performance statements, you'll have the trading month, and then you'll also have your year-to-date results. So a financial year is from the 1st of July to 30th of June next year. And so the year-to-date will be tracking the performance for each of the months that have been completed. If you do have any questions along the way, just yell out, please. Don't feel you've got to put a hand up or wait till I ask. Now this is where, as I said, I know you guys didn't get into hospitality because you love numbers. And as the role of accountant in a business, I can't provide owners, managers with a full story either. We actually have to work together on this stuff. So the performance statement is a communication tool. What it does is reports the results, but it doesn't tell you the whys. That's where you guys come in. And so working together, so if you have an understanding of finance and your finance team have an understanding of the operations, you've got a really powerful team there to focus the effort of your group to get some really cool things done. Neither party can do it without an understanding of what the other does. And it's not right for the accountant to come in and go, oh, this is wrong, this is wrong, this is wrong. And oh, well done here, because without sitting down and actually having a discussion of this is lower than we expected, why is that? And it's the why that you guys really can separate yourselves from the pack as well. If you understand what your business is doing, and you become a really valuable employee and a fantastic manager, because you can target the efforts of your team into those areas you know are going to make the best return, give you the best bottom line contribution. So yeah, very important. They don't answer performance statements, don't answer the why question, but they help identify where to put effort and where to ask questions. The other thing to keep in mind when we're looking at our performance statements is that for the month just passed. Now, that can be relevant, but let's not spend too much time talking about something that's already happened. Let's use that information to change what we're planning to do tomorrow, or what we're planning to do next week, or even let's make some notes and plan what we're going to do next year at the same time. Let's say there's we had an unexpectedly poor result for the month, and we have a discussion and we identify it was because there was an external event on. Let's say it was the Christmas pageant, and you've got a hotel that's in town. The Christmas pageant keeps customers away, so you know that ready for next year. When the Christmas pageant's on, you're able to reduce down your roster perhaps and manage it for your expected customer base, not your regular customer base. So again, it's the why. We bring it back to the why of these results, what they are, and it just positions you ready for anticipating the next thing. But certainly that puts some pressure on your accounting finance department to get these results to you quickly. If they're not, then there's really not a lot of benefit in getting them. Like month end finishes on the 30th or the 31st of the month. If you're not getting them to the 28th of the next month, you've actually lost nearly a whole month's opportunity to change stuff. Now that's not fair on you guys, because then you're going to have another discussion when the results come out of why the results are what they are, why the contribution isn't what we expected. Or, I talk about the bad things, but often that's what we focus on in our results analysis is where we could do better. The reverse of that is that certainly we should be looking for where results have outperformed our expectations. Let's keep doing more of that. But unless you take the time to look and drill down, that could be an opportunity lost. The other thing to keep in mind with performance statements is that they can often have some allocations in them that are quite arbitrary. For example, you might, in our business, we have two departments, bar and dining. Now, the same customer might buy a bottle of wine and dine in our restaurant. We have to try and allocate some labour to each of those product groups. So it gets a bit messy, it's a bit hard to explain, it's a bit hard to understand, and it can be hard to manage. So there's also a need to discuss that stuff to find ways for you guys to manage your business, because those allocations, whilst there's a reason for them, they do make it confusing when you receive a report and the numbers aren't what you've been tracking on a weekly basis through your rostering system or other mechanisms. It can be quite confusing, so we just have to be mindful of that too. Just another point is to make sure that your accounting department give you the opportunity to review the statements before they go to the stakeholders, before they go to your managers and your owners, because there could be some stuff missing in there, or there could be errors, and we talk a little bit about that in the handout. But you should develop a relationship with your finance team that they make sure that you're considered and your input is considered before it goes to your supervisors, those reports, because those reports are assessing your performance. So you want to make sure that they're an accurate reflection of that. So please ask for drafts or copies before they get distributed other places.
Julie?
Yes?
Sorry, I'm not sure if anyone's asked this question, but what if people are not allowed to get this information? What if they're...
Yep.
What if it's been kept away from them?
Well, there's... the performance statement itself is pretty sensitive. For an owner, that's the amount of money that's going in his or her pocket at the end of each month. So they can be very cautious about sharing that information, and rightfully so. It's sensitive. But if you're accountable for something, then you have a right to be able to collect the information to do your job. Now that we can talk a little bit more about that with management reports. So the performance statement, as I said, it's a monthly collection of data. There's reasons why it's not the best tool to use either. In our business, it's quite seasonal, and also trade is often skewed towards weekends. So if you're looking at a year, July this year to July last year comparison, there might be a different number of weekends, and so a month of 31 days that is a moving target isn't as good as a weekly performance report. So you might be able to set up a management report that does the same sort of thing for you. But I believe that managers need to have the information to do their jobs. Now, something that we use here a lot, and certainly is quite common across the hospitality industry, is margin analysis. This starts getting a little bit numberish and financial, so we'll take it slowly, and again, please ask if there are any questions. Now, why are margins useful? A margin is sort of like, how many cents in a dollar did I use to pay for wages? Or how many cents in the dollar did I use to pay for my menu cost? You can compare across venues. So if you have a venue that, I don't know, has $200,000 worth of food sales, and you compare that to a venue that has, say, $25,000 worth of food sales, it's unfair at that high level to compare one to the other. They're completely different operators. But they should still be looking to minimise their costs. So margins allow us to compare that. So business A, the larger business, might have a labour margin of 40 cents in the dollar. Business B, whilst having less sales, might have a margin of 20 cents in the dollar. So they're spending 20 cents on labour. The bigger venue is spending 40 cents per dollar in labour. So that actually suggests the smaller venue is more efficient. So that's one of the purposes for it. Certainly it allows comparison across time. That example where I said different number of weekends, if the margin is not something that gets affected by that. Your sales number might, because you might have more bar sales on a Friday and Saturday night than you do earlier in the week, but a margin allows you to monitor your costs across time. Now, again, I apologise that this is starting to get a bit financy. As I said, we put a lot of focus on margins here. How much of the dollar are we spending on labour, on cost of materials? How much is left to pay other bills? And how much is in our pocket at the end of the trading period? But keep in mind, you can't bank margin. And this is the example. Consider a 20% margin on $20. That's $4. Whereas 5% margin on $200 is $10. Which one would you rather? I'd be going, if it's a contribution, I'd be going the $10. More money in the bank. And this point here is something that you guys as managers need to consider in your planning and your strategy. Do you go for low margin products and try and get high volume? So lots of people buying a smaller value product. Or do you go for high margin products and each sale is worth a bit more money? So and the strategy is quite different. But when you're deciding what you're going to do for your daily specials, your menu setup, drink specials, even what products you're going to stock at the bar, what customers you're going to go after, all of that becomes important. Are you going after volume or are you going after margin? Be nice to have both, but they're actually two different tools. So these are the three that we often look at: gross profit margin, labour margin and contribution margin. So we'll talk quickly about each of those. Okay, so our gross profit margin is the amount of money, amount of sales revenue, we'll just say amount of money, that's left after taking out the cost of goods sold. Has anyone had a chance to look at that formula in your handouts? It's because these are all formulas in how to calculate them. Where are we? And you'll see in your handouts we talked about performance indicators, and then we go on to talk about margins and ratios. So gross profit margin, the formula is there. As you can see, the use, it helps to assess the efficiency of the business.
Sorry, which page of this book is that? 19? Yep, of the training manual. Thank you.
So it's how much it's costing you in product cost to serve that drink or to serve that meal. So it could be 60 cents in the dollar, 70 cents in the dollar, 30 cents in the dollar. Each business, there'll be some industry standards, and it's probably somewhere around between 60 and 70% maybe is the target. But it's going to be unique for each business because different people put different costs into their cost of goods sold. Some might include Glad wrap or alfoil. Others won't include them in the cost of their product. The wrapping paper for the burger ends up being, well, I would consider that a cost of serving that meal, so I would put that in the cost of goods sold section of our expenses.
Where else would they put it?
Consumables, like down below, is an overhead cost. But that, you know, it is what it doesn't matter. It's what people are familiar with. So how about, let's just talk then, what sort of things can affect your gross profit and therefore your gross profit margin? The two variables are your sales and the cost of those sales. So what do you think might affect the margin? Let's talk about sales first. What if you had a 2-for-1 offer? What do you think might happen to your gross profit margin?
Decrease.
Correct. And why do you think it'll decrease?
Because you're not getting that profit margin for the second item, you're
Yep.
getting it first.
Yep.
So
Yep, spot on. What about if a staff member's not putting the money in the till for the sale? What do you reckon happens to your gross profit margin?
because
So-
If they haven't put the money in until you don't have the money, it doesn't matter.
You've served a meal, you didn't get any money for it, so your gross profit's actually, your margin's going to go down. That's right. What if we had a cyclone and all the tomato plants were destroyed, so the price of tomatoes went through the roof and you didn't adjust your menu?
Lose money again.
Correct. Yep. What if your suppliers overstocked in, he's got a whole heap of beer that's about to go out of date, so he gives you a free carton for every 3 you buy.
Increase your gross profit.
Yep. Yep. So I hope you can see it's as simple as that. It affects one or the other. It'll go up or it'll go down. And that's a pretty important thing when you're talking to your stakeholders. And Saturno guys, we do focus a lot on margins. It's not a bad thing to have a lower margin if you were going after that volume of sale, because as we saw before, it's money in the bank that matters at the end of the day. So if you're going after more sales, trying to attract more people, you might drop your prices a little bit as a special, but you do also have to be careful, of course, with specials that you manage them as a special. It's got a start and a finish date, so it doesn't become a customer expectation that you're going to be a cheap venue or you're not going to increase your prices or anything. So that's, just keep that in mind, that specials should be treated as that. And in gaming's a little bit unique. Gross profit margin incorporates your gaming tax. That's the cost of doing business, rather than purchasing supplies from suppliers. Now, labour margin. Labour is, as you would know, one of our biggest costs. That's why people go out. They want to be served. They want to feel special. So labour is also one of your staff are one of the ways you can make a difference. But it's expensive. In context of all of the costs of our business, labour is one of our biggest costs. Now, the labour margin measures the percentage of sales revenue that goes towards paying for wage costs. Now, if you have a look again at our definitions in our did I put it in here? Break even. Oh, there we go. Sorry, I haven't got page numbers on this, but page 20, thank you. So the measure provides information on the relationship between sales and staffing. It can be used to assess the efficiency of rostering or practices. Keep in mind when we talk labour, it's not just the cost or the wages that go into the staff members' pay packet at the end of the week. It's also superannuation, work cover, possibly payroll tax. It's sick leave as well. So you have to be aware that $1 labour cost paid to a staff member is likely to be somewhere between $16, $27 actual cost to the business because of all those other hidden overheads. Now let's talk then, as we did with the gross profit margin, what can affect your labour margin? Breaking it down again, you've got labour cost, you've got sales. So I guess we've already talked about the sales side. Labour, so how about the labour cost side?
Too many staff.
Too many staff? Absolutely.
Inefficient stuff.
Inefficient staff, good one. And by that you mean the number of meals or drinks that they're serving in an hour. That could be slow. Is that what you mean by that, David?
Yeah, I think so. Or
Yeah.
ones that sort of
Aren't multitasking.
mucking around. Those
Yeah. Or even perhaps not doing all of those
small
back of house jobs, the polishing and the cleaning, and you have to bring someone else in to cover that. Yeah. So labour cost is the number of hours that you use and the rate that you're paying. So other things to think about is obviously finishing, to your point, overstaffing. Make sure you finish people early if you can. But also think about who's doing the jobs that are required to be done each day. If you bring in a qualified chef to do prep work, that's going to cost you an awful lot more than if you brought an apprentice in. Think about your staffing mix as well. Do you have two RPs on at any one time? Could you bring in a trainee and start developing them as the next sort of flow of people through your business? But trainees are much more cost effective than someone on one of the rates under the HITsa or your...
It's more about smart rostering and knowing.
Smart rostering and smart employment as well. Yeah, you have to make sure that your staffing mix is right. Number of casuals, number of full-timers, salaried staff versus wage staff. It's pretty complicated actually. But the important thing to keep in mind is that labour cost is based on hours plus rate. The hours stuff is pretty straightforward, I guess. You know you can send people home. You know if someone calls in sick, do you cover that leave or can you do without it? But the rate stuff is a little bit less obvious and takes a bit of thinking time to make sure that you've got the right mix of people and you can take opportunity of less expensive labour if it's appropriate. Contribution margin, that is the profit for a department divided by the sales. How much money is left after operating that area to pay for, say, overhead costs like unless you allocate it directly to each department, but rent and electricity and borrowing costs if you borrow some money. Now, if we talk about the stuff that might affect your contribution margin, it can be the labour like we just talked about. It can be your cost of sales that we've talked about. It might be that you've had a big equipment breakdown for the month and you've had to, unexpectedly so, and you've had to call in someone to fix it at short notice. That's often one that can affect contribution. You might have run a promotion for the month and so you've got promotion costs, but you would hope, if you've done your analysis correctly, you've had an increase in sales as well, so your contribution is actually better. If your contribution is down and you've got some promotional costs in there, sales haven't changed, well, you start thinking maybe that promotion didn't work as you'd hoped it would. Oh, what do we got here? Nothing. I just want to emphasise my point again that you don't bank margin. So whilst it is an important indicator, it can't be looked at in isolation. Money in the bank at the end of the day is certainly what we get measured against, these are margins are efficiency measures, and they certainly are important, and they're a great management tool, but they may not indicate what contribution a hotel is going to make. And use this example here. One venue had a great gross profit margin of 72.5%, and they contributed $260,000. Another venue had a lower gross profit margin, 68, so that's 4% different. But look at the difference in the contribution at the end of the year. That's just to make my point. Okay, so we need to have that bottom line focus in your roles. It's okay to spend money. You need to spend money to make money, but you don't want to waste money. Now, if you have a look at this activity 5 example again, once you've gone through and calculated all the missing values, for the month, the reporting month of August, our contribution, which on here is referred to as EBIT, was $20,689. Revenue for the month was $206,000. That's a big number. But 90 cents of every dollar we earn went to costs. That's a big number. And if you have a look how it's broken down, labour 22 cents in the dollar. That's a labour margin, but that's a different way another way of looking at it. It was 22 cents in the dollar went towards paying for our labour. Gaming tax is 24 cents. There's not much you can do about gaming tax. It's just based on how much gaming revenue you earn in your hotel for the month. So that's a fixed cost. Can't do anything about it. You can do something about 22 cents. And look, maybe 22 cents is efficient. I'm not saying that it is or it isn't, but certainly it's a big cost. You want to make sure you've got it right. Cost of goods sold, 15 cents. Is there any opportunity to get some economies of scale? Do you look at your supply contracts? Do you negotiate across suppliers?
Wastage would come into that too.
Wastage, absolutely. Make sure that portion control's the other one as well. Yeah, just make sure that your kitchen staff and your waiting staff are controlling what people are receiving for free, I guess. Bread rolls, I don't know if people have bread rolls out in a basket, but I'm sure they're probably a pretty high cost item, I guess, overall. People like to think they can get something for free. So it has to be controlled. We're not saying you can't do it, but just be mindful that it's a cost to your business. And why not try and upsell something? If you have something for free, why not try and offer them something that you're actually going to get a return for? I'll have water for the table. Perhaps you can offer them a soft drink or a juice or something that is attractive. Is an attractive option to the free water. Overheads 11 cents. That's manageable. Rent 7 cents. You probably can't do much about that. Gaming promotions 6 cents. That can be controlled as well, and you'd want to make sure that your promotions are in fact adding value to your business. If they're not, stop them. So I hope you can get a sense that our job is to look at the contribution of the business. It's bottom line focus. That bottom line is made up of revenue and expenses. You've got two areas that you can influence and need to manage, need to understand. There is no point earning an extra $100 of revenue if that revenue costs us $150 to do it. Entertainment is one that perhaps that's a consideration of. We need to give our customers diversity and a great night out or a great experience, and entertainment might be part of that. But then you think about, if you took the entertainment away, are people still going to come? If that's the case, maybe it's not essential to your business. if it costs, because of course you've got your entertainment, you also have to tell everyone about it. So there's probably some advertising costs. You might put on drink specials, happy hour. So there's another cost. Well, lost revenue because people are paying less for the drink that they would have paid full price for. You need to look holistically at any initiative that you're going to run and make sure that you're confident that it's going to provide a positive return. That return can be through increased customer numbers or increased spend per customer. So you have to take the time to think with an initiative who it is you're trying to attract. And then, are those people coming already? Like, we need more of those people. So no point advertising something internally because it's probably not going to attract any new customers. You have to get out there on Facebook and your website and possibly newspaper media and banners and however else you can tell external people who are not already in your hotel to come on in and have a look. And then, are you going to offer them the same thing so that you're looking for an increase in revenue because you have more people in your hotel? Or are you wanting those and or the ones that are already coming to your hotel to spend a little bit more? Now, spending a little bit more is probably a less costly initiative because you can get your staff to upsell. Would you like a dessert? Oh, I see, someone orders a drink. Have you tried this particular product? Because I think you'll enjoy it because if you like this, this is actually great. It's a little bit more. It might have a better margin. There's no shame in upselling. You should do it with confidence if you have pride in your product. You want people to try everything that you've got. With any initiative that you're looking at as well, think about what's at risk. Are you going to upset existing customers if you bring in a nightclub? Is that the right thing to do for your business? A nightclub might attract the 18-year-olds. Is that who you're trying to attract? Are they going to spend more than your existing group of middle-aged entertainment seekers? Just be aware of every initiative risks discouraging another customer group. You can't satisfy all the people all the time. So you go after the initiatives that are going to give you the best return. And you want to be thinking long term as well. Like a one-off fun night can attract a particular group. They have a great time, but you may not want to be trying to capture that group all the time. You might have a really stable, profitable, regular group. You don't really want to do things to upset them. I'll get an example of that, what's at risk. For us, we run a loyalty program, and 3 times a year we offer our loyalty members we call it a pub card party. And it's just a bit of a thank you for being a member of our program. But interestingly, it attracts lots of customers who don't come very often, so that's a big tick for us. We want to show them what we've got in the hotel because they don't come often. But what it does do is our regular gaming customers don't always like those days because the room is busier and there's a party atmosphere that perhaps they don't enjoy so much. So on those occasions, we'll see that some of our regular customers don't come. But that's okay because it's a one-off, and so we're trying to manage different groups of people on different days, perhaps at different times of the day as well. Another example perhaps is student groups. So uni students like to come for pub crawls or that style of event. That customer group really doesn't mix well with the middle-aged diners, for example. If you've got one area which is a combination of dining and bar, that's not going to make for a very pleasant night out for your diners. So what would you do? You would, a couple of things, if you've got regulars, you might tell them that this group is coming. You might, as you're taking the bookings, you would say, yes, perhaps I should fit you in at 6 o'clock because at 10 o'clock we've got a big group coming through, so you'll have a more pleasant time if you come earlier. manage the student group by allowing them to come to your hotel at the times your regulars aren't going to be upset. It could be a bit later at night, it could be a quiet weeknight. You know, there's 7 days of the week to make money, and certainly as a manager, it's clever to try and utilise your less busy periods as an opportunity to offer something new to different groups. Certainly think about the cost of any initiative. Is it going to cost you more in staff? Do you have to decorate your venue, entertainment, product discounts, all sorts of stuff. Security is a big one. That's certainly expensive. Necessary but expensive. And then, okay, I know what the cost looks like for the event or the initiative as I've thought of it. Are there any options? Is there any opportunities to adjust the cost by changing some of the offer? So if you have an idea and you do this pre-work before you go and talk to your stakeholders, your managers, your owners, you're halfway there to getting it approved and getting on with it. This sort of analysis shows that you're thinking about it, shows that you're thinking about the contribution of your business and you care about it. Coming up with an idea without this effort is a little bit disrespectful, I guess, in terms of you're asking someone else to do that thinking for you, but it doesn't demonstrate the quality of your management style. And I'm sure if you're all here doing the Cert 4, you're looking to improve and just refine your management skills, and this is certainly a way to do that. It just reflects really well on you if you go to your supervisors with an idea and with that pre-work. And that's where your accounting and your finance team should be able to help you with that stuff. So, what you should be thinking about when you leave here today. Our high-level numbers in our performance statement, our revenue, particularly revenue, but also their wage cost, has some building blocks. Customers, spend per customer. Gaming revenue is turnover, which essentially is customers and spend per customer. But turnover and I call it yield, the amount of win, the amount of money people receive from playing gaming. Food and beverage, number of covers and spend per customer. Wage costs, rostered hours and wage rate. If you want to manage your business well, set up your reporting systems to be tracking both sides of these calculations. The way to do, I mean, that's not going to be in your performance statement. And so as we were saying earlier, that's not necessarily the key report you guys will be using in your day-to-day jobs, but it is what you're going to be measured on. So you'd want to be setting up some management reporting on a more regular basis than monthly to keep across what's going on. So I like to look at weekly analysis. Because the number of days in a week doesn't change. It always has a Friday and a Saturday. So it's the most consistent basis we can look at. I also encourage you to share information with your teams. Now, it might not be the financial numbers that you tell them about. First of all, they're confidential, and that's really, really important. But they also may not understand them. If you go and tell them, oh, look, our gross profit's no good, you know, we've got to get down by 2%, I reckon you'll get these glassed over looks. And that's fair enough. But you can tell them, I want, you know, a portion that's this big, please. Wastage, you know, you're overpouring. Let's do some training so we can practice how to pour a cocktail, how to pour whatever, how to pour a beer. desserts, for example, if you want to increase your sales, maybe you have a bit of a staff competition about who's going to sell the most desserts this month. If you're going to do that, like display it, make it healthy competition. It's quite amazing the difference that measuring and reporting something can make on a group. If it's done in the right way, it can be really powerful. An example of that recently for us was we were having through the HITsa, there was a fundraiser for the Hutt Street Foundation, and it required hotels to ask customers if they would like to donate $2 on their bill. We weren't collecting a lot of money, so we started advertising each hotel's collections in our weekly newsletter, and you should have seen the difference. All of a sudden it became quite competitive and healthy, of course, and positive, but there was a little bit of rivalry and everyone wanted to be the best. So it just demonstrates the value of reporting the right things and communicating to your staff. Keep them involved, because then it makes it relevant to them. Talk to your finance guys, talk to the owners, make sure you're clear on what targets are being set for yourselves. Talk to the finance team about what information they can get to you. They're probably more familiar with computers and Excel and those tools. You shouldn't have to sit in an office and create all this stuff. A lot of it will be available in your point of sale system anyway, but certainly your finance team should be able to set some stuff up for you and get it out to you quickly and regularly. Reviewing cost and revenue allocations, that's, as we were talking earlier, labour cost can be allocated across departments. Not sure whether you can influence that or not, but we just also need to find ways to make sure you get information that you understand and can actually manage with. So thank you for your time.
Thank you.
And I hope hope you got some value out of the session, and good luck with your studies and your careers. Thank you.